Well, our next guest says there could be more pain ahead for the sector, the healthcare sector. Let's get to Chris Verrone at the Plasma. Chris, what are you looking at?
Hey, Melissa. Yeah, well, certainly one of the weaker sectors in our work. And, if we just look at the last several months, I think what stands out to us most importantly, as the broader market has grinded higher, you've had a series of lower highs for the healthcare group. And, when you look at it in relative terms, it's really been the story of risk on, risk off. When the market was risk off, healthcare worked in the second half of 18. When the market's been risk on, healthcare has underperformed. And it leaves us, in relative terms, versus the S&P, precisely where we've been over the last year. So let's look internally and let's see what's going on under the surface. And I think what's most important here, the percentage of healthcare stocks above their 200-day average continues to decline. So internally, the setup's actually getting weaker, even as the stocks here have gone sideways. Just 50% of the group above its 200. So when we look at how do we play this at the stock level, certainly UNH, one of the weaker names. In the very, very short term, it could probably bounce here back to that 240 level, but we're a seller of rallies, and we're a seller of rallies because this long multi-year uptrend that's been in place for 4 or 5 years is now broken. When trend is down, we sell rallies. When we look at a name like Eli Lilly, this has been one of the winners in the group. But I think the risk now is, with the sector deteriorating, is there a risk for Lilly? It's still $10 above its 200-day moving average. At the same time, its relative is starting to peak versus the S&P. So deteriorating name, still risk back to the 200. That's about $10 lower. Is there anything we can own in this sector? There might be some biotech that's getting a little bit better. This is Alexion. Let's remember, this is a 50% bear market over the last several years. It's been quietly basing right around this 140 level. And as the rest of the sector has gotten worse, this one's actually quietly starting to turn up. This has been the anti-defensive name. We think this is one way to play an otherwise weak sector.
All right, come on over, Chris. Evan will bring the chair over. Thank you,
Great
Evan.
music. Tell you what, Evan's doing it. Did we create
it's
this?
growing on me.
Is it our own?
No, I think it's like freemusic.com, and you pick a tune, and there you go.
Freemusic.com,
Freemusic, whatever, something like that. So just the overview. Break it down within the sector. Is it as easy to say biotech, yes, insurers, no?
There's some signs of life in biotech in a risk-on market that we might want to entertain. But when you look at hospitals, you look at insurers, you look at pharma that, frankly, has probably run too much here, it's a sector that's deteriorating. And, it's certainly oversold. We could get a bounce over the next couple of weeks. We sell rallies and downtrends, and there's a lot of downtrends in that sector right here.
Does it matter that it was the best performing sector last year? Does it make this rollover more convincing that, it had the big run last year, so people are
I think it speaks to the idea that the market broadly is trading on, risk off backdrops. We have all the risk on cyclical groups firing on all cylinders right now. Industrials getting better, China getting better, Europe getting better, autos getting better. Today, utilities, weakest group, staples, weakest group, healthcare rolling over. I think this is about the market starting to price in better economic growth. And if the market's pricing in better growth, I'm not sure I want to own healthcare. I don't want to own utilities. I don't want to own staples.
So, and Chris, let's not confuse Chris using the middle finger to draw, saying that he hates his insurance companies.
Why do you have to bring that up every single time the poor man is on?
Maybe it's a bad joke. But bottom line is, I guess that's my point. So are you looking at the contrarian indicators or something like staples, for example, which actually has been reasonably, I would say, performing in this environment despite all the risk on?
I thought one of the great contrarian signals last week was the IMF downgrading growth. Everything we look at says growth is getting better here. Copper up, iron ore up, steel up, China up. I just don't want to own defensive yield proxies in that environment. I think the world is getting better call is still underowned, and it's one that we want to embrace.
So I'm just going to connect the dots. Bank of America Merrill Lynch had their flows survey out, and it said that the most crowded trade, I think it was the fund manager survey, the most crowded trade right now is short Europe. So if we should be pricing in growth, and an upturn in growth, is that going to those people are going to be crushed in this trade?
We think it's crowded to be negative on Europe. We love it here. Look at the European autos, BMWs, the Daimlers, the Continentals. These things were down 50% last year. They priced in a lot of bad outcomes. They're all getting better. Look at the European luxury names, all getting better. This is where we think you want to find risk on exposure this year going forward.
When do you get less risk prone in the markets? Do you look at the S&P to dictate from top down, 50,000 foot up macro versus granularity, or do you look from the bottoms up where you start to see the utilities, the staples, these names start to rally?
Sure, we look at leadership relationships. We look at discretionary versus staples. What's better? Discretionary. We look at copper versus gold. What's better? Copper. As those things start to inflect, that dictates how our call evolves from here.
Chris, good to see you.
Thanks
Thanks
you. Good
for
seeing
coming
you.
by. Chris Verrone of Strategas. Guy, where'd you
Can I talk about UNH real quick? I mean, the stock's down 24% in the last couple of months. It trades at a valuation it probably hasn't seen in decades. Great American company. The quarter was fine. Not only was it fine, it was a beat and a raise.
Yeah.
And people are just shooting first, asking questions later because somehow they believe that magically things are going to change. I still say buy the weakness.
Yeah. Pete, quick.
I would agree with Guy. I mean, and by the way,
UNH.
UNH, great company. You got to love them, Minnesota.